In this video, I will compare a high yield stock with a dividend growth stock and you may be surprised by the results. Therefore, keep watching and share your questions or thoughts in the comments below. When many people start building a dividend portfolio, they put too much emphasis on dividend yield, and this is where they go wrong. How most people visualize dividend investing is simple. They invest their capital into a stock, assume their capital will remain intact, and expect dividends to start flowing at some point. Over time, they believe this will become their passive income, and it can lead straight into what's called a dividend trap. A dividend trap happens when investors chase stocks offering extremely high dividend yield, often ignoring whether the company can sustain these payouts over a longer period of time or not. A high yield is sometimes a signal of financial stress that the company is carrying, and these dividends may be reduced or eliminated when external conditions get tough. Even worse, these companies often see a drop in their share price, leading to losses after they cut their dividends. Let me demonstrate this to you. I will assume an initial investment of $10,000 to be invested over a period of 10 years. Our company A is a high yield stock known for its astonishingly high dividend yield of 10%. This will pay out $1,000 annually as dividends, which totals to around $10,000 in payouts over 10 years. A whopping 100% return in dividend payouts alone. Now let's assume the stock price also appreciates by 2% annually. Over 10 years, this will result in another $2,200 in capital growth. If we adjust our original calculation of dividends for this appreciation in capital, that will add another $1,000 to the total. So your $10,000 investment has now turned into $23,200 over 10 years when combining for dividend payments, capital growth, and original capital. This might sound appealing, and it's the reason why many people start chasing high yield stocks. What better can it be than investing $10,000 and it becoming $23,000 in 10 years. Now let's shift our focus to a different company. Company B is a dividend growth stock. These stocks usually offer moderate yields. Let's assume 4%. Now 4% compared to 10% may not seem appealing, and that's where a lot of people overlook these stocks. Over 10 years, the dividend payouts will be around $4,000. The real power of dividend growth stock lies in their potential for capital appreciation. Let's assume an annual growth rate of 8%. Over 10 years, this results in $11,600 in capital growth. Adjusting our original calculation of dividend payout for this capital appreciation, the payout will increase to $5,800. But there is more. Dividend growth stocks tend to increase their dividend payouts each year. This is known as a dividend growth. Let's assume a 4% dividend growth rate. This adds another $1,400 over the decade. Now imagine this. You were not in it just for your passive income, but for long-term wealth accumulation. This is where dividend reinvesting, also known as the drip method, and capital growth work together like a compounding machine. So what is our investment worth now? Well, let's recap. Our high yield stock had 10% dividend yield, 2% growth rate assumption, and over a period of 10 years, it ended up with $23,200. On the other hand, our dividend growth stock had only 4% yield, but was supported by 8% capital growth and 4% dividend growth. And we also switched on our dividend reinvesting approach. So what was the total? Drum roll, please. When you put all of it together, your $10,000 investment in a dividend growth stock with these assumptions would actually turn into $33,400 over the same period. This beats our high yield strategy focused on passive income by a wide margin. The dividend growth strategy clearly outperforms the dividend yield strategy. So there is a bad news. There is no shortcut to that early retirement through passive income. But good news, you now understand how real dividend growth works. Investing in dividend stocks isn't just about dividend yield, but also requires focus on dividend growth and capital growth. And it is just as much about consistency in the investing approach. While high yield stocks provide more income upfront, dividend growth stocks build momentum over time, offering both steady income and capital growth. Now let's go to stockanalysis.com and take a dividend growth stock like Chevron, ticker symbol CVX. Let's check the dividends tab. Here you will see the payout history. If you scroll down further, you will also see the dividend amounts and growth trends of dividend over time. Now let's move back to the real reason why we are here. It is the summary tab at the top. What most people do, they focus on dividend yield and payout frequency. And there's nothing wrong with that. We will also use that information in our analysis, but the problem is they end their analysis here. Well, let's see how we do it. We will first look at the yield. Too low or too high is typically a red flag. Well, too low is not that bad in the case of growth stocks, as they will need all the capital for fueling the growth, but too high means that a company is actually starving itself of capital. Next, we will look at the payout ratio. This tells us how much of the net income is being paid out as dividends and how much is being retained by the company. If this is too high, typically above 80%, other than the case of REITs, it would again be a red flag, as it makes the dividend payouts unsustainable. Next, we will look at dividend growth, which is the year-on-year growth in the amount of dividend being paid out. But 1 year of growth can be a random instance. It can be luck. Look at the other parameter here. This tells us the number of years the stock has been continuously growing its dividends. Now that's a story to tell, and it's very impressive. In the case of this stock, there is a history of 37 years of continuous dividend growth. Is that it? No. The secret ingredient is right there, hidden in plain sight and often overlooked by many fast-paced investors. It is the buyback yield. Buyback yield shows us how much the company is using to repurchase its own shares. This reduces the number of outstanding shares in the market, effectively increasing the value of each remaining share. For long-term investors, this is the hidden boost for their overall returns. When combined together, dividend yield and buyback yield gives us the total shareholder yield. In the case of Chevron, the combined yield is an impressive 7.38%. In a bearish market, dividend growth stocks with strong growth history, moderate dividend yield, and a regular buyback yield tend to hold their value better than speculative high-yield stocks, which may cut dividend and see capital values plummet as soon as they do so. Effective dividend investing requires looking beyond just dividend yield. Always combine capital gains, consistent dividend payouts, reinvested dividends, and buyback yield for the full picture. Remember, dividends come from a company's earning. If a company consistently pays unrealistic dividends, it risks snowballing its debt. A balanced, growth-focused strategy often yields better results over time. Well, I hope this video helps you understand the fundamentals of dividend growth investing. Share your questions or thoughts in the comments below and start building a smarter portfolio today.